Hello everybody, and welcome to this channel, The Wealth Tree. Today we're going to learn about what to do or how to start velocity banking. Stay tuned, we'll take a look. A little bit about myself. My name is Hugo Correa, and I came to the United States as a legal immigrant in 2008. The housing crash was just happening, and a lot of people were telling me, don't go, or things are bad over there. I still wrap up and came. The other thing that happened that I was actually very surprised, I sold everything I had in Puerto Rico and I came. And to my surprise, I barely was able to grab or save $2,000 to my name to actually come to the States and start. Um, One of the things that actually was also very hard was I didn't came prepared at all. I came without a plan. I came without a job already lined up. I came without a place to stay. So for the first few days, I actually stayed in a Motel 8 until I found a room to rent. But I'm going to just go over my story real quick. And when I came, I had over $30,000 in debt. My credit score was a 399. And once again, I had nothing. Um, but from there to now, I can say today I am making uh, over six figures. I have a credit score over 740. I have no debt other than my house. And I have used over the time that I've been learning, I have used multiple strategies. And that's what I'm here today. I'm here to help you understand all the different strategies to be financially independent, financially freedom in your finances. You got to know four things: your income, your expenses, your debt, and essentially your cash flow. And we're going to break those down a little further. Your income. Everybody's different. So income for some, how much, right? $2,000 a month, $4,000 a month, $10,000 a month. How often? Is it every week? Is it bi-weekly? Is it quarterly? Is it monthly? You have to figure that out. From where? It's a reliable source, meaning is it a paycheck? Are you going to work? Are you an entrepreneur? Do you work in sales? Depending on how much you sell, it's how much you make. And then is this amount either gross or net, right? The difference really is after taxes or before taxes. And that's important because we need to know how much money we actually are going to use to attack your debt. Expenses. Expenses, something that Robert Kiyosaki said is, and he's the author of Rich Dad, Poor Dad, he says that your bank statements are now your report cards, right? When we were in school, we had to make sure that our report cards look good, our grades and all that kind of stuff. In this case, for adults, our bank statement is um, our new report cards. Use the last 3 months. If you used the last month, you could have probably gone to eat out more, or probably went on a mini vacation, or probably spent some time with some family members and took them out to eat, or took them out to have fun at some place. And because of that, it's difficult to sometimes get the last month statement and make it set in stone. In this case, if you take the last 3 months, you can kind of see your patterns. How often do you go out to eat? Um, how often do you buy things for the house? How much is in groceries? If by any chance you did not have a budget, this is the time to probably make one. And don't get scared. We don't have to make a full-on blown budget. All we have to know is how much do we spend, or how much do we use in expenses every month. And if you take an average of the last 3 months, that's a good indication. And in my case, I always say go on the higher end if you have the money to be able to say, I still have money left over. Because if you go on the higher end, then we can always do better than our original plan. Des, please put down all the debts. Some people, I don't know, they cite themselves. I'm not going to put all debt. This one, I'm going to pay it out soon. Put all your debts down. So the order that I would like you to put your debts should be the name of your debt, credit card, loan, whatever it is, if you owe it to somebody else, your balance, the interest rate, how much they're charging you for the money that you have in there, your monthly payment. Something that if you guys don't already have is the monthly interest rate. That's good for me, even though I not everyone has to do it, but it's good to know how much of your money of that monthly payment it's actually going to interest rate and how much of that is going to principal. And then how much do you have left? How many terms do you have left? If it's credit cards, normally put on indefinitely, right? You normally charge some things on the credit cards and pay it off, or if you have a high balance on that credit card and you're not charging anything else to it, then you can probably put in there. It might take 3, 4, 5 years in paying it off. Okay. The last one out of the three numbers, we already said income, expenses, and debts. Now is number 4, and that is your cash flow. And cash flow is very simple. In the formula I have it here, it's cash flow is income minus expenses. So essentially, the money that you make and the money that you spend. Whatever is left over, that's what we call cash flow. And this number is the most important part to the velocity banking because that's how we know how much can we pay ahead or how much can we put to one credit card or to one debt in order to pay it off. Part 2. What is your debt tool? In velocity banking, we use a tool or a credit card or a line of credit, a lock, or a personal line of credit, a PLOC or a HELOC, a home equity line of credit, in order to pay down our debts. Kind of sounds weird. You're kind of robbing a Peter to pay Paul, but you're going to see how this is actually more effective and a lot faster than just a regular Snowball and Avalanche method. Things to look for. What is the limit? I put 2 examples here. Chase credit card, $9,000, or if you have a line of credit, a $15,000 line of credit. Things vary depending on your situation and how much available credit you have. Normally, the line of credit, you want to make sure that it's completely paid off. But if it's not, that's still, you got to identify which one is going to be your line of credit. We normally want the line of credit to have the lowest interest rate because that's going to help also in the debt acceleration. What type it is, credit cards or a line of credit, does it charge simple interest rate? The difference between a loan, which is amortized, and a credit card or a line of credit is simple interest. Simple interest is calculated daily. How much you owe on that credit card or on that line of credit daily, that's how much interest you will accrue daily. Are there any intro periods? Sometimes when you find a credit card or a line of credit, they tell you you have 6 months with 0% interest, or you have 12 months with 0% interest, or you have 18 months with 0% interest. Or sometimes they give you an intro rate. Instead of having a regular 8%, you might have a 2.5% or a 3% or 4%. We are going to monetize that part of the intro rate. And then what are your chunking capabilities? What we mean by that is how much money can you use at once? In velocity banking, we normally have a rule. We don't want to go over 70% because then you're just using debt in a wrong way. If something happens, then you're out of luck. Now all your money is gone and you have nowhere to run. If we use 66 to 70% of our debt tool, we can, if we find ourselves in an emergency, we can always use that line of credit still in that emergency. Getting out of debt is just going to take you a little longer, but you can still have a plan with velocity banking. Do you have one? If you don't have one, how to get one? There's certain things. Of course, you need a good credit score. You would definitely have to call your agency, your bank, to verify what is the credit score they're looking for. I have seen people with 750's credit score and get denied because the bank was looking for something else, or they were getting denied for another reason, which we're going to talk later. Next one is, what is your debt to income ratio? This is very important. Once again, this is mainly when I've seen people with 750 or close to 800 credit score getting denied for a line of credit because of the debt to income ratio. What this means is how much of your income that is coming in is actually being utilized to pay debt. And the banks have this math where they say, hey, if people are above 45%, above 50%, or above certain amount, they're more risky to lend money. That's one of the things that you want to make sure you know. Hey, bank, what is your debt to income ratio? What is the debt to income ratio you're looking to be able to loan me money? If I know that little bit of detail, I can come into my own personal finances, look at my income, look at my expenses, and then figure out how much of my money is actually going out. And if I'm within their criteria, then I know I'm good. And how much you should ask for. Look, this is kind of tricky, right? It depends. Everybody's situation is different. But normally, you don't want to ask for way too much, because then you use more than what you actually need, and you can come into a point where you can get into more debt instead of getting out of debt. And this is very important. The whole point here is to get you out of debt, not to get you into more debt. Even though to get you out of debt, we're gonna transfer debt. We're not gonna get you into more debt. We're gonna transfer debt. That's what velocity banking does. Normally, again, it's 12 to 18 months. So let's say a person has a 500 cash flow, right? Um, you can ask up to $8,000 or up to $10,000. That's normally what we recommend, but it depends your situation. If you realize you're gonna alleviate or eliminate some debts really quick and your cash flow is gonna increase between those 12 to 18 months, then you can probably go for a $15,000 or $20,000 line of credit. But again, if you have $100 cash flow, you have no business trying to get a $20,000 line of credit and trying to maximize it, because then we're gonna get into the same cycle. If you can't get one, no worries. We can always start velocity banking with what you have. Watch some of my other videos where I start working with some families that do not have a debt tool, yet we can go faster than Snowball or Avalanche. Again, that's not just going to stop you from implementing velocity banking. Velocity banking is a strategy. It's not just a line of credit. If you implement velocity banking correctly, you can get out of debt without having to obtain a new line of credit. We can use what you have. We can use what you have existingly in order to pay down debt. But if you want one, you can work on doing the Snowball or Avalanche method to bring down your debt to income ratio, and improving your credit score, which essentially will improve by paying down debt. Your debt utilization is also another thing that they look for. Part three, and this is my favorite part, to be honest. I really enjoy looking at all the possibilities and figuring out what to pay first. That's probably my favorite thing to do. So there are three methods. We're going to talk the two methods that pretty much everybody knows, and the method that really velocity banking is all about. Snowball. Dave Ramsey is known for being the snowball master, or the debt guru, debt payoff guru. And Dave Ramsey says the debt snowball method is a debt reduction strategy where you pay off debt in order of smallest to largest, gaining momentum as you knock out each balance. When the smallest debt is paid out in full, you roll the money you were paying on that debt into the next smallest balance. So pretty simple. This is, you have a list of, which I have here, a list of debts. And I pretty much arrange them in balance from smallest to largest. And what this does is, for people that might have $500 cash flow, let's say, you can probably knock the first one within 4 months. If you have a goal in mind, you feel much better knowing that by this time you're going to pay off one debt. Now, the cash flow that you're going to be saving is $500 right here, or sorry, $50, right? And that's why it's in order number one. And then number two, and sequentially, right? From lowest to largest. And as you go paying off, that's why it's called a snowball. Now, those $50 are going to go into the next one. And the 500 that you had initially, 550 are going to go into the next one, including the $80. That's all it is. And you essentially keep rolling downhill. And as you keep paying down debts, the snowball gets bigger. Method number two, avalanche. Avalanches are for those that don't want to give the creditors more money. One of the things that we see here is how much money are you paying in interest? So out of the money that you have in that account, this is on average how much they're charging you in interest. So from the $111 payment that this person, or in this scenario, it gets paid to the credit card company, Chase, $62 are going to interest. So we're talking about maybe $50 are going into principal. When you look at it, you're paying less than half to your principal. And next month, the $4,853 will go down to $4,800, even though you paid $111. And believe it or not, it's a lot of people that don't know um, that this is what's happening. All they know is I use a credit card and I pay, and that's it. This is what Avalanche is going to do for you. It's going to save you hundreds, if not thousands of dollars in interest. This is always for the person that wants to pay less in interest, that wants to pay less to somebody else just for having your money. Here you can see the order in where the payoff, what to pay first, it's in order of interest. Highest interest will be the first one to pay off. Downsides to this, it's going to take you more time to pay off the first one, but by the time you're done, you know that from there on, everything else has a lower interest rate. And this is for far how we do velocity banking. Cash flow index. If you had never heard of this, this is extremely simple, but revolutionary. Cash flow index is a formula, balance over minimum payment. And that will give you a number. What that number means is for every $19 that I pay into this debt, or for every amount of dollar I pay into this debt, this is how I save, or I release $1 of my monthly payment. And we'll talk about it. In this case, if you divide $7,235 into $368, your cash flow index is $19.66, right? For every $19.66, you are releasing $1 of those payments. Why is this important? This is important when we do velocity banking. We are determining our chunk, and our chunk is really how much of money are we going to take from our line of credit and pay off debts. So what we're doing is debt consolidation. We're moving debt from regular credit cards or from a loan into your line of credit. And in return, we're going to pay less interest. One, because you probably have a less interest line of credit or credit card. And two, because from a loan to a line of credit, the interest is simple interest. This is always the best option. But verifying what is your cash flow index will let you know if I have this amount of money to make a chunk, what should be the first few debts that I should pay off. And here you guys can see you have a $7,000 debt, $368,000. Right underneath, I put a little scenario. No matter what you do with any of the other debts, you still don't get $368 of cash flow freed if you had by any chance $7,500. So here it is, right? We use, in this case, the cash flow index lets us know the best approach would be to pay this first, $7,500, and we release $368, even though if the interest is high or even though if the balance is also high. Compare this to any other option. In this case, we had Chase 3 and Amazon will only release $190 and we still pay $7,019. All right. How much was this one initially? $7,235. Let's go to the next one. Chase 2 and LL Bean will only release $191. So I had to pay $300 more to release $1 in this one. And this one, the most enticing one, Chase 1 and Chase 2 will only release $220. And even if we had the extra $1,000, let's say, to pay into the next small one, the Amazon one, we will still have $900 left for next month that we'll have to pay. And the only thing we release is $50, which is not much. 220 plus 50, we're talking about 270. It does not compare to 368. We're talking about almost $100 more in any situation, no matter what, by doing the cash flow index. Yes, we're not going to save as much in interest in some of the areas and a lot of cash flow moving forward, which now can accelerate the payoff of the $7,500 if you had 500 plus 368, $868 to pay off this debt. And then the last step, part 4, rinse and repeat. It's pretty simple. Once you pay it off and you are paying down all your balances down, in this case, let's say that the person was using the $7,500 to pay that debt, which is a student loan. They pay it off. Now they're moving all their cash into that line of credit, taking out only their expenses and leaving in there the cash flow. It would lower their monthly payment on a monthly basis. And by the time they're getting close to paying it off, then that's when they have to reassess. Things change. You might have put something, you might have refinanced a car, you might have traded in a car if by any chance that car broke down. You might have put some things in a credit card and you do this all over again. But having a plan like this, where you know exactly what to pay first, no matter your situation, if you do not have a line of credit or you do not have a credit card, you can use Snowball or Avalanche, whichever one is better for you. If you have a line of credit or a good credit card with an intro period, you can then use the chunk to pay off a bunch of debt and increase your cash flow immediately. I love doing this for people. I love helping others and setting a plan for them in order for them to see when can they get out of debt. Once you see that end in sight, it's so much more refreshing, so much more free. You feel free. And that's the last thing I want to say. Get a hold of your debt so you can build a legacy that lasts for generations. That's one of the things that I've been focused on. Through the last 12 years in the United States, I've learned envelope method. I've learned Snowball, Avalanche, what to pay first, what is cash flow index, and even how to set up your own bank with whole life insurance. And when you learn all these strategies, you can then implement it on yourself, get rid of debt, and then have a plan for all that cash that you're going to have left over. If by any chance you think this is too hard for you, give me a call. Book a free consultation and we can go over your numbers and kind of set up a plan. I'd like to help you get out of debt and build a legacy.